So am I audible? Please type audible. If not, do you want me to be a little louder? Please type in audible if I'm audible. Give me a thumbs up. Thank you. So investments, when you talk about investments, what all does come to your mind? Can you type in the chat box? What all things come in to your mind when I say the word investments? Quickly. Anything that comes to your mind whenever you talk about investments? FD, RD, MF, okay. RD, FD, yes. Shares, fixed deposit, mutual funds, LIC, gold. Great. So common, if you see, it comes as FD or RDs. For women, gold is a common form of investment, right? But which asset is that contributes to the real growth of economy? Because why are we investing? Because when economy grows, we grow, isn't it? So which asset contributes to the growth of the economy, and how can we participate in the growth of the economy is what we need to understand. Okay. Now, who we are an online mutual fund investment platform. It's called PG Asserts. Earlier, the name was Precise Gold. So you can see the website, precisegold.com. It is PG Asserts. We ensure that we provide a comfortable investment experience for you, and we help clients to onboard as easily as possible. If your KYC is done, it hardly takes 30 minutes to start your investments. Location, we are based out of Chennai, Tamil Nadu. Our primary focus has been that, see, there is a lot of education products, things coming. Please, I want all of you to mute yourself so that we have a smooth session. Okay, it's for everyone's benefit. Thank you. So in finance, people are completely burdened with too much of information, right? So we do not know which to choose, which not to choose. Everything seems to be good. I'm completely confused. Everyone is selling something, but where do I really invest? So our goal has been to simplify this investment journey for all the clients, and we give unbiased suggestions that whichever suits you, you go ahead, right? It's only suggestion. We don't push clients. You do this, do this, do this. You have to take the decision for yourself, right? Only knowledge giving is our work. And in case you want any support, we are ready to support. So our primary focus has been to work on goals of investors and their objectives and make it everything comfortable. So why us? Here we are two partners, Mr. M. Delhi Babu, who is a certified financial planner, and he has more than 18 years of experience in financial planning and wealth management. And he has worked with huge brands like ICICI, IFL, Geojit, and Funds India. And in Funds India, he has headed the financial planning desk and done more than 5,000 of financial plannings for the clients, right? Depending on their financial needs. And he always focuses on the client's requirements, and we take immense pleasure to bring our services to you. And me, I'm Hema Raju, I'm partner here. I was a wealth manager. I shifted my career from being into a corporate almost 13 to 15 years to as a money coach, where I work on both money EQ and IQ, right? So I have worked with top banking firms like Kotak and ICICI, and we have handled almost every product in finance, from shares, equity, options, futures, to bonds, insurance, and whatnot, right? Everything we have handled, and we know what works for clients and what doesn't. So we together come here to ensure that clients are well informed and they are given knowledge and not sold anything, right? So what are the basic components of investment? What are the 3 elements that you need to know if you want to have a successful investment? So when it comes to investing, 3 most important components that you need to work upon is return. We all talk about return, how much return I will get if I invest here. So yes, return, but with return comes risk also. What product is risky, less risky, high risky, and what risk and return combination can actually create my wealth, right? Risk has to be taken in life, no matter where, even in marriage. Whether it's a love marriage or arranged marriage, risk is there. I hope all of you agree, right? We cannot say ki arranged marriage is risky or love marriage is risky. Everywhere you have something that is risky. So everywhere the risk is there in the life, it is inevitable. But if you have better knowledge, then automatically you take better decisions. And then comes taxation, because taxation is a very important component, which you need to decide ki where I invest and how much will come to my hand net. So what will be my purchasing power? We will understand it going forward. So as I was talking that we have different asset classes in investments. So gold, we have real estates, fixed deposits, equities. When you all of you have shared know where you would want to invest, I think you have missed to tell about real estates, which is also fancy for a lot of us. We invest in properties also. Now, which of these assets are contributing to growth of economy? One or everything, right? So which drives the economy, which drives the day-to-day functioning of our lives is what matters. And that decides that when you ride on that, automatically you grow. Now, what does an FD do? FD takes the money from you, and where do they invest? They again invest into markets. What does the insurance do? Insurance is taking your money. Where do they invest? They invest into markets, right? We have heard of DIIs, domestic institutional investors, FIIs, foreign institutional investors. What are these people? The provident funds, the insurance fund, all these funds where your fund is being kept there is being deployed for better returns. And those funds take risk and grow their money. For you, they give a fixed return, right? They're growing the money, but taking the risk. Beyond whatever they have given to you is their return, right? That is how the economy grows. So finally, where is the money going? In the markets. Again, real estate, gold, equities, right? So all the money goes into equities. Gold is a form of exchange. If you would have noticed, gold doesn't grow by itself. Now, a lot of people have been talking ki gold is growing so much, and isn't the gold the best investment? But when it comes to investment, you don't see 1 year, 2 years. Investment means more than 5 years. There's a difference. Now, in 5 to 10 years, what is that gold would have given returns? If you see, whenever markets have fallen, like recent example would be the COVID. Wherever there's a fall in the market or the mishap in the market, what happens? The whole money is pumped into gold and the gold prices jump. And so you see there is a hike in gold prices, and the last 5 years, the gold has extremely performed. Okay. So gold is an asset where it is for safety, where the money is parked for safety, where markets don't look lucrative. Okay. Real estate, I don't have to tell you. Real estate has its own ups and downs. The prices no increase and decrease as per the macro, that is the government policies, and no appreciation or growth of this economy. Land's price also goes up and comes down. There are a lot of other challenges to it also. When you want to sell, liquidity, you have some litigation problems, safety problems. A lot of them are there in every asset class. So risk is inevitable, but everything has its own advantages and disadvantages. Clear? Now, when I say growth of an economy, what is that measures the growth of the economy? It is GDP. I hope most of you would have heard about the word GDP. Yeah, I think there was an internet connection problem. Please stay connected even if the internet drops. So I'll be connecting back. Okay. Yes. So GDP is something that measures the growth of an economy. And what decides, comprises of GDP? If you're not aware, then the main thing, 4 components of your GDP is your first, personal consumption, business investments and growth, how the government spends, and exports and imports. Okay. So I'll keep it very short and simple here, not to complicate. Personal consumption is what? Day-to-day, we buy food, we have buy accessories like soap, oils, and beauty products, your clothings, your whatever you want to consume on daily basis, right? Healthcare services, all these are consumption expenditures. Next comes business investments, where is the government investing its money to grow? Third comes government spending. For what all services government is spending? For infrastructure development, for the growth of the economy, subsidies for the people, education. How is it government spending? And final comes exports and imports. It has again a very major impact on how much is our import and export. The more the exports, better it is for the economy because it is more self-sufficient, right? So these are the four components which comprise of GDP and ensure the growth. Now, how do you participate in all these things? Where government is investing and what contributes to the personal consumption expenditures? Say example, you are using a car, you are having, say we are taking health services. We are also buying clothing, laptops, computers. These are all companies, isn't it? IT services, you have consumer goods services, you have banking services. So all these companies are the ones who are delivering these services which we are consuming, right? Where do governments invest? Government invests in different projects, right? Infrastructure project. Say, who are all the people who are into infrastructure projects? There will be cement, right? There will be construction company itself. There will be other scrap, whatever material suppliers, iron is included, steel is included, labor is included. In one construction alone, there are so many other, say departments are involved to be in a diplomatic way. So all of these are growing when one project comes into place. So if there's, say example, a car, you want to buy a car. So we say Tata is a brand. Now, for Tata, who all are supplying the auxiliaries? Labor, spare parts, seats, leather, roof, the metal, steel is also involved there, tire is involved there. Who does that? Different companies. There's a company which supplies the doors, supplies the tires, supplies the whatever other aspects of the car, right? So now Tata might be a big company and it's supporting the growth of other small companies also. This is how each transaction, when we are doing or when government is doing or export or import is happening, every company is participating in that. Clear? Any doubts so far? Anyone? Any doubts in this so far in GDP? Give me a thumbs up if you're able to follow me. So I know that you're following. Guys, are you awake? Clear. Thank you. So this is GDP.
Clear. Yeah.
Now, what happens? How do you see that whether your economy is growing or not, or whether you invest in a certain economy or not? Now, US is a developed economy. India is an underdeveloped economy, right? So already US GDP is in double digit. But where is our GDP? It's hardly 8%, okay? So it's a single digit growth. Now, when we say the growth, even from 8 to whatever number it has to move, the growth will be double digit percentage. Whereas if US economy has to grow, it is growing in by 4% or whatever. What is our GDP growing by? So in the terms of growth, and developing economies have an edge because they are still developing and they are growing in double digit. So whatever we invest is growing in double digit. Whereas in developed economy, already the growth is above 11%. So now when it has to grow, it will grow, but in a single digit. So what do we need? What is the current growth? Where is the GDP currently, or how GDP is going to grow decides whether your investments are going to grow or not, your business is going to grow or not. So that is why India is being seen as the best place to invest now because it's the fastest growing economy. When people talk about fastest growing economy, why they are saying so? Because India is growing in double digit, right? From 8%, when it has to grow to the even 11%, is going to be double digit growth. And that is what they are mentioning. So that is why they say India is the best place to invest. I mean, even the foreign investors and whoever. Now, how does the asset classes participate in GDP? Now, we spoke about gold, we spoke about real estate, we spoke about FDs, we spoke about equities. When it comes to equities, your personal spending, you are getting a salary, so or any income you're getting, you're going to buy whatever, clothing, textiles, no, beauty products, luxury items, whatever. Now, entrepreneurs, when they're setting up new businesses, they are setting up new ventures, contributing to the overall growth, giving job opportunities and more expansion. Government is, as I said, participating in the growth of other companies. For example, if I'm giving a service and government is able to fund my service, so through me, government is also reaching the other sectors, people, population where it is helping. Mainly is infrastructure and housing development projects, which we already spoke about. Trade balance, most of you know. So these are the places where equities are through equities we are participating. Now, golden land, in both golden land, there is no participation of GDP. Okay. So only the tax what you pay in the gold or land is what goes to the contribution. Yeah. So as I already told, gold is only a hedging product, which is seen as a safety where you park money when you don't see opportunity elsewhere. Okay. So these are only debt investments. They're not equities. So what do I mean? They're not equities. They don't contribute to the growth of the economy. They only safeguard the capital within. That's it. Right? So only when you invest in an asset that is going to contribute to the economy growth, that is where your money will grow faster. Whereas other assets are only going to give you safety of money and not growth of money. This we need to understand. Okay. So any doubts here? A lot of people talk to us and ask about why not land and gold and why equities. So that's why we tell here that they are only the assets when nothing is performing, you safeguard the money. That's it. It's only for safety. They will not give you wealth creation. Wealth creation cannot be done with that. Say if you have 100% investment and you're in the age of I'm facing some connectivity issues here due to rain, so I'm really sorry for that. I'm just changing my connection. Yes. Yeah. Am I audible? Okay. So,
Yes,
only when we invest,
you are audible.
thank you. So only when we invest in some asset that is going to contribute to your economy growth, then you will see your money growing. And that is why we have brought this here. Lot of clients ask the same question to us about the gold and land investments. Okay. Now, let's see what is the returns that come from different forms of investment. Now, this data has been taken by checking the 8-9 years holding period of these assets. Okay. Bank savings account, 3% is the per annum returns, average returns. Fixed deposit, 8.5%. PPF, 8%. Gold, 8.9%. Equity mutual funds, it is 15.5%. It is seen from the past data. We always calculate returns with past data because we never know about the future, right? So how does it come? We have taken all the asset class. So gold bees, if you see from 2015 to 2024, this is the rate of growth it has given. That is hardly 9%. That is the average growth. If you see this 32% of the gold has, the 32% growth came in just the 2020, that is a year of COVID. Otherwise, it was only an average performance. In fact, it has also gone negative sometimes. Now, PPF, we know it is depending on the interest rates. FDs, they keep fluctuating and all the asset classes keep fluctuating. So which is the asset which is giving you highest return is the equity mutual funds. Now, let's compare if you in forms of money, because sometimes percentage doesn't make it clear. If you had invested amount of 10 lakhs in different assets, what is going to be your growth? Now, as you can see here, let's see from the FDs. I had told you that we're taking 8.5% return for FDs, 8.9 for the gold, and the equity mutual fund growth was 15.5%. And you're going to hold the same asset for 9 years. So what was the result? Now, the future money value where my FDs have grown to 20 lakhs 83,000, gold has grown to 21 lakhs. We will come to equities later. But I told you what are three components of investment: risk, return, taxation. So sometimes return looks fancy as if a return has come well. But post taxation, what is my net return that I am getting? In FDs, if you see, you are losing your money to your taxation. Already inflation, the growth rate is almost equal to inflation, which I have not brought it here. Again, beyond taxation, the money which you're getting is far less compared to any other asset. Even better than FDs where gold is performing, where it is giving you at least 2.5 lakhs extra. 2.5 lakhs extra compared to the return that you are getting by investing on your FDs. Okay. Clear? Now, in equity mutual funds, the taxation is hardly what? 10% above on the profit above 1 lakh. So up to 1 lakh of profit is no taxation. Beyond that 1 lakh, whatever profit is, charge 10%. Right? Now, what is it? Just takes care of the inflation, takes care of taxation, but the net return which you are getting in your equities is far, far higher compared to your other safe assets, so-called safe class assets. Clear? Any doubts here?
Hello.
Can I move forward? Give me a thumbs up if you have understood the explanation. Okay, done. So now, purchasing power. I was talking something about your purchasing power. In the So what is purchasing power? How many of us understand purchasing power? Is whatever return that comes to me is equal to my purchasing power?
No.
Only the money which I have in hand for spending after all my this macro numbers. Like what is the macro numbers? Inflation, after I pay tax, then net is what comes to my hand. And that is what my taxation, sorry, my purchasing power.
Purchasing power.
So if I am now earning say 10 lakhs and I want to buy a bike. So bike or a car. So can I buy the car or the bike or any asset for whole 10 lakhs? No. 10 lakhs will not come to my hand. In the month of Jan, Feb, March, we have a taxation time, right? I think most of you would agree that not your whole salary comes into your hand. hardly part of it comes. It's very painful, right? You see some numbers in your pay slip and the number which comes to your bank account is very less, right? No, so this is your purchasing power which remains in your hand. Now, after taxation, inflation. What was costing me 10 lakhs earlier or 5 lakhs earlier, today same product is costing me double or might be 25% higher than the earlier thing. So my purchasing power has reduced. I can only buy less than that. So this exact thing what I can buy which comes to my kitty is called purchasing power. So when you invest on some thing, you need to know at the age of so and so, what will be my no purchasing power, that is amount in hand for deploying for my needs, is what the true purchasing power that we need to understand. So here we have displayed FD and mutual fund, because FD is a common asset that where people invest in. So assumed returns is 8.5%, as we already discussed, and tax slab the highest 30%. Most of us are in the tax slab. Post-tax return is what? I have 5.95% in my hand. Inflation as of last year was 6.4%. Abhi to increase ho gaya, it is nearly 7. So what is my net return? My net return is negative. I mean actually minus. So most of the investment products which are giving you, telling you fixed returns. See, I have also been into insurance. And the reason I quit was I didn't like the product. And then after 6 months, I thought, mujhe nahi karna hai, and I quit it. Why? Because even when they give you guaranteed product, if you calculate that they're giving after 10 years, you pay some amount and there will be no taxation and you will get 20 lakhs after so and so period. But did you calculate the purchasing power or the inflation of so many years? If you calculate, whatever amount you paid, you have been given back. So whatever the amount, 10 lakhs is equal to 20 lakhs as per the records. Actually, after inflation, the money is same. 10 lakhs today, right, is equal to 20 lakhs 10 years after. There's no change in the purchasing power. So where is the money grown? Money has not grown. You think 20 lakhs mil raha after this time. But you should not see your investments like that. You need to calculate the purchasing power, inflation kya aa raha hai, and what will be my cost that time, cost of living that time, and so what is the money I am getting to spend there, right? In mutual funds, we are not taking 15% growth. We are taking only conservative number here, 12%. 10% is the highest tax what you would pay. Post-tax return is 10.8, and even after your inflation, still 4.4% is in your hand for your disposal, right? So this is what we have taken, a very conservative number. When we take a period of 10 years or 15 years, easily your portfolio grows by 15 to 18%, right? And that is common, that is history. So we do not want to talk about it, right? So we need to check about your purchasing power, and that is why whenever clients come to us, we talk about financial goals. Ma'am, what is your goal? What is the amount as per today you want to have that day? So that if as per today there's some amount, then we calculate what would be the cost that day. And so accordingly, you have to plan and invest, right? Today, 1 crore, 10 years after the 1 crore, the worth would be hardly something. Okay, 1 crore, it might not be that big. So when you plan your investment, that is how you need to plan. Clear? Right. So now coming to risk. So I think I already said risk kahan pe nahi hai. Where do we don't have risk? In life, everything is risky, right? We do not know how the kids will grow tomorrow. What will they study? How will be their future? We do not know tomorrow if I'm awake or not. So we are planning. So risk is everywhere. If you see FD also, they say no risk. No. Even if banks default, hardly they can only guarantee you up to 5 lakhs. Are you aware of that? It is not risk free. Risk is there, but might be it is comparatively lesser. So you feel that bankrupt hone ka kitne chances hai? Hardly something, right? But recently we have seen a lot of banks give data of a lot of NPAs and insolvency. Real estate, most of you would have gone through the pains of real estate. Okay, land, government rules will change, wrong acquisitions, paperwork, brokerage, and the safety, pricing power change. Sometimes it doesn't appreciate. For years, will not appreciate. Suddenly, boom, in the prices. So even there is a risk, right? Though you feel ki I have physical property in my hand, but do you see how much of mental stress you take behind that? We still have. Even if we take in rental income, we have a lot of challenges there. I hope you all agree. Stocks, there is a capital risk. When you buy shares directly, and if that company goes bankrupt, then your money is zero. Market risk is there. Corporate governance, like Yes Bank, recently Satyam, right? So many big Suzlon, big companies, Reliance, the Reliance Group, right? What happened? Reliance Power and no other part of Money Group. Leave the Mukesh Ambani, their brother, right? So these were one of the top companies, but what happened to them? They were the nifty companies. But when there was a governance issue, they all came to double-digit, single-digit return. Now we have the risk there also. Gold, only the market risk, the market fluctuation ups and downs. And your equities also, you have only the market risk. Only if the market is coming down, your investments looks like coming down. When markets move up, your investments look good. Now we need to understand how much risk it is worth taking and how does it give me returns. So this understanding is what most of us are missing. And this is where we just see the term risk and think money will go down. No, there are ways to mitigate it. When we talk about risk, we need to see, is this risk possible to be mitigated? Now in FDs, can you mitigate the risk? No. If the insolvency happens, you cannot do anything. You don't have control. In real estate, you cannot mitigate the risk. If you buy a property, it is vulnerable to all those problems in that place. Stocks, you cannot do anything because the data given to you, we are trusting. We are trusting the data given by the companies. How do we know that you have a corporate governance risk there? Right? Gold and mutual funds, whatever is the market risk, can be mitigated. Yes, when you stay for long term, when you're averaging, when you're diversifying, definitely it is possible to mitigate the risk, and that is why it is worth taking if you work smartly. Clear? Now let's talk about mutual funds. So far we are fine. Any doubts on other asserts we have? Any doubts on the other asserts? Can we move forward? Okay. Now, what is a mutual fund? How is it different from stocks? How is it different? Now imagine we all are going for a vacation, right? In office we organize, or in families we organize. Let's take an office vacation. Now, say I am organizing the vacation, and so what is my responsibility? I have to choose the location, I have to choose the budget, right? And now what happens? I tell each one has to contribute, say 5,000 rupees for the trip or 1,000 rupees for the trip. Everyone trusts me and gives me the 1,000 or 5,000, whatever. Now I collect this money, and now according to the population, how many elder people are there, how many have kids, how many men, how many women. So what are needs of the men, what are the needs of the women? So how do I budget this money? Where not I should allocate, where should I cut down? Where can I save the money and where can I spend the money? Right? For stay, travel, and then whatever events we have to organize. So it's me who has to decide how do I allocate this money so that everyone is equally enjoying the party. Clear? Exactly like that, in mutual funds, we have the fund managers. So what happens that the money is being pooled from investors like us. We all put the money there, and there's a fund in which there is an allocation of different asset classes. So any asset can be bought. It can be gold, real estate, IT, whatever. Any assets, there will be a combination. Now this fund manager collects the money from us, and he is the one who decides which one should be invested how much, so that I give optimal return. And what happens? That return is being distributed among us depending on how much amount we have invested. This is what happens with your mutual fund. So as I told you, we are investors, we are pulling the money and the fund manager invites the money. You have seen our ads, right? Recently, mutual fund ads have started coming. The recent ad has been for Samco, right? A lot of ads on that. So that you pull in money and you invest. So fund manager is getting money because he has a strategy. He tells you what strategy I'm going to invest. So like which trip I'm going to go. If you're interested, you're going to give the money to him. And now he will deploy the money into different securities, right? Gilt funds, debt, equity, or gold, real estate, ETFs, foreign funds, wherever you want to invest, they will deploy. And the returns are being again passed down to us. So the beauty of here, the mutual fund is that this fund manager, what is he doing? He's allowing you to invest in all the assets. Now, if you invest in gold, you're only investing in gold. We're investing in land, only in land. So it's vulnerable. Every asset is vulnerable. When stocks, only stocks, debt equity, right? So it's again vulnerable into that companies. But in mutual fund, what are we doing? It has been distributed. And that is why this fund manager is the most experienced person of the market who has all the knowledge and experience and he knows how to run a fund. Fine. So he has a team under him who works for him to research with companies, sectors, or whatever the current trend, macroeconomics, and everything based on which he compiles the data and decides where to invest. Now I ask all of you a question. Tell me, can you do the same thing with your portfolio? Can you sit and do research, extensive research of all sectors and companies, of all the news happening in the economy or across globe, and you can you distribute your money into the percentage, like there's a rule for every portfolio. So can you exactly deploy that money there? And do you have all guts to book losses when the stock you picked up is not doing good? And do you have the right bandwidth to book the profits on the right time? Tell me. So type yes if you think that so much of things you can do on your own.
Can you please repeat that question? Your voice was breaking and we couldn't hear.
Okay. Yes. So let me just put it this way. Now I said the duty of the fund manager is what? The fund manager is trying to pool in the money and he is trying to just a second. Am I audible? Now the voice is clear. Is it fine now?
Yes.
Yes. So my question is, I had mentioned that a fund manager is a person who pools your money. So he has a team to research on the company sectors and the macro information also. And then he decides what percentage of money has to be included in which asset and which companies. Now, say you are the one who is managing your portfolio. You have a good knowledge of finance and everything. Fine. So how much you're confident that you can research all sectors and all kind of news happening around the globe and make decisions? How much time can you spend for that? Number two, how much confident you are that in case your recommendation goes wrong, you will be able to book the loss and come out, minimum loss and come out. And how much confident you are that when some of your stocks are growing well, you will book profit the right time and come out. And how much you're confident that you will spread your portfolio exactly the way it has to be done. 100%, 50%, 25% you can type. Okay. How much time it will take in no, for you or to spend every day or every month or every week? So we need to spend some time on this research, isn't it? It is not possible, no, that we are also doing our own other business or employment or family and also keep involved in this, right? So if we want that freedom, that the money is being taken care, that is why this fund manager is helping us. Any doubts so far? Shall we move forward? Give me a thumbs up and I will move forward. So why mutual fund? When you go to stocks, you're only again able to invest into equity stocks. Again, there is market risk plus corporate governance risk and the capital risk. But in mutual funds, we only have what? Market risk. Otherwise, you have diversification. REIT, that is your real estate and IT companies. You can invest in bonds, you can invest in gold, you can invest in international markets. Otherwise, you have to separately work for everything. You have to open an international account and then trade there. You have to track individual stocks. You have to have the proper portfolio. Again, gold separately you have to track. You have to separately track your real estate. But if you really are keen to have a wealth creation, then all these assets can be invested by through mutual funds itself. And that is the best thing about something called mutual funds, where you can participate in equity, which is contributing to the economy's growth, and also have other assets which can hedge your portfolio. I have told you that gold and real estate are the hedging components and not growth components. Fine. So now let's see what all benefits. I think in the so far session, you would have known that now your mutual funds is giving you flexible options for wealth accumulation. You're having professional people who is taking care of the portfolio, where your time and energy is saved. You can focus on other business. We say let money grow while you sleep. It should not be that you're completely behind money 24/7. You're working somewhere, but your brain is completely, what is happening to my investments? You are sleeping, oh, tomorrow what will happen to the markets? How are my investments? No. What is the money if the money doesn't allow you to sleep properly? Money has to work for you and you not work behind money. Okay, money has to be the byproduct. Now, what happens when you have a professional person? One is a fund manager who is taking care. Number two is your advisor, personal advisor, who tells you to choose from those funds available. And beyond us is what? Regulatory bodies, which ensures that certain rules and regulations are followed for the investments. Right? So that is how you have a professional management and oversight. Diversification, I told you that in mutual funds, you can buy any kind of stocks, large cap, mid cap, and small cap. Large caps give you what? Average return. I mean, a consistent, say 12% or double-digit return. But small cap and mid cap is what gives you higher returns. It elevates, accelerates the growth of your portfolio. 20%, 30%, 40%. Right? High liquidity. Mutual funds is one asset which you can anytime go and withdraw your money. It is possible with your mutual funds. Any other assets, you have a risk, liquidity risk, where you cannot get the money immediately. You have to go through a lot of process. Tax benefits already discussed. Low transaction cost. You know about land, how many transaction costs we incur. You know about gold also, wastage and service charges, whatever it is. Here, it's only your exit load less than one year if you are exiting. Otherwise, even that is not there. So only the tax. There is no other hidden transaction charges that you pay in your mutual funds. Safety. Why it is safe? Because you're doing it for a long term. Even 3 years and above is a long term, and you will not be seeing any losses. And what? Systematic investment. You're not investing all the money at once. When you buy month on month, the volatility is being taken care. Markets might be up and down, no, any time of the year. We cannot say that when is the down market down or up. But month on month, when you invest, you're buying the stock at 100 rupees. You're also buying the stock at 50 rupees. And the average is what? Your cost is 75 rupees. So when you're systematically averaging your stocks, automatically your risk again gets mitigated. Right? So this is how your mutual funds are actually helping you to invest in the growing economy. Now we say risk, right? How do we allocate based on the risk of people? If you see here, we have the returns and the risk. Higher the risk, higher the return. Now, if you want to just withdraw the money immediately, then it's the least risk. Where you have liquid funds, you have low duration funds and ultra short term funds. Here, the money can be invested for even a few days to 3 months. So this, if you're a person who is having money in RD for a short-term commitment or having in a savings account for a short-term commitment, but you do not know when and what, then having in liquid funds give you an edge over a savings bank account. Whereas you can also take the money, there are no charges here. When you withdraw the money also, there's nothing hidden. But it gives you an edge on returns compared to your savings account. Right? If you're keeping even in the money in FDs, right? These funds give you a better prospects. 6 months, 1 year debt funds you have where you keep it for short term. Now, if you are a person who can take medium risk, what do we say medium risk? The risk is calculated based on your duration of investment importantly. Okay. How soon you would want to take the money decides your appetite, because duration is what gives you returns also. I will explain that in the coming slides. If you're a person who is a person who can stay up to 3 years, then we would invest the money into what? Dynamic assets, where the combination is changing. Conservative hybrid. When you say hybrid, it's a combination of equity and debt. Okay. Multi-cap funds or large cap funds, because large cap funds are safe, right? They don't fall much or they don't raise much. Or multi-cap, where you have a combination of large cap, mid cap, and small cap as well. Aggressive hybrid funds, where equity combination is more and debt component is less, but they are still combined. Okay. Hybrid means a combination of debt and equities. So this, if you are investing more than 6 months to 3 years, then we would park your money in this kind of funds. In case you are ready to park your money for really a wealth creation goal, like 5 years, 10 years and above, then we would go for directly into sectoral funds. They give you better returns. Best example is like COVID. The pharma did extremely well. The IT did extremely well. Again, small cap and mid cap funds, which give you higher return, but they are more volatile. So when it goes to long term, this volatility is mitigated. And that is why we say still it is safe, but if you're only long term. For short term, going into a sectoral or small cap, we don't suggest. It depends on client to client. Clear? Any doubts so far? Is my pace fine? Are you able to follow? Thank you, Himlata. Now, why do you need someone to help? When mutual fund is already designed, you have a fund manager who is taking care of the mutual fund, then why do you need an advisor? Now, mutual fund is a very vast ocean-like investment thing, right? Now, the first set of filter is already done. They have they have created a portfolio, they have regulatory norms, the percentage, portfolio allocation, everything is done. But would you choose 25% return or you will choose 18% return? So what decides this 25% of return is a combination of right funds that you choose. Again, diversifying and allocating the proper portfolio. If you see in mutual funds, you have 44 plus AMCs, asset management companies. Like most of the banks have the AMCs like ICICI, HDFC, HSBC, Edelweiss, Parag Parikh, all of they are asset management companies who create funds. So basically the manufacturers of the funds. Now in each AMC, they have 2,500 plus schemes. Each AMC has 2,500 plus schemes. And under each scheme, there are 30 plus subcategories. Can you see here? We have equity. So every AMC will have equity funds, debt fund, gold ETFs, hybrid funds. And in debt fund, again, I have an overnight fund, low duration, long duration, banking, gilt, subcategories. Now, out of this lakhs of fund, how do I choose which will give me absolute return and which is safe, which is more liquid? That is where your advisor who has been expert in that, who has been suggesting so many portfolios, we know with experience and our education, which to choose and which not to, because we will go through the strategy of each fund. What strategy is this fund manager implementing? And is the strategy failure or success in the past? Based on that strategy, then we will suggest you, if this fund looks good, go ahead and invest. Clear? It is not easy to choose from so many funds. So what clients do, the people who are doing in their own, you have in Grow app, you have Zerodha, there is no customer service. Nobody calls you and tells you, ma'am, do this, do that. Only when they have a target, they'll call, otherwise no. So you are doing on self. What is happening there? Because you're doing on self and you want to be conservative, you are investing in what? ETFs, index ETFs, passive funds. So passive funds are giving you an average return of whatever is the market growth, 15%, 12% or 17%. But your sectoral funds or any other funds like aggressive funds can give you 20% and above. Why will you lose that chance? Because you don't have a person who can ensure you or give you guidance on why you can do this or which fund you can take. So when you have someone who knows about your financial goals, automatically they would guide you through how to get to that goal faster rather than going the conservative way. So there are a lot of permutation combinations that we work when you're working on the portfolio based on the market. Clear? So we spoke about diversification. Now let's talk about risk and return. Now, why does markets get sold? We all fear, right? The market is getting sold. If you see here in, there are so many times that there's a decline. .com bubble, my 56% market is down, right? COVID, 38% market was down. I'm telling you the major downsides. Political uncertainty, 40% down. Harshad Mehta scam, 54% down. But can someone type in the chat box, what is common in this chart? What observation can you find in the chart? What is the observation in the chart? Okay, let me display it. Yes. Someone has said something. It jumps down and there is an increase. Great. End of the day, graph goes up only. Right? So I think if you are from North and you have seen the movie Om Shanti Om, in personal development we see, agar ending happy nahi hai, to wo ending nahi hai, right? So finally markets have only to go up. Why? Because the whole economy is only working based on the markets. Your insurance, your PFs, your FDs, all the money is in the markets. So markets cannot crash. During COVID, the money was printed to bring liquidity into the market, if you are aware. That is why today we are facing inflation again. So markets have to anyway grow. Why fear? Utilize the fall is what we want to tell you from this chart. The message which I want to tell you is that when markets fall, see it an opportunity and don't fear. The fall is never permanent. Maximum 6 months to 1 year. Anything happens, still markets have to go up. Okay? All you need is emotional quotient and your resilience to understand why you should wait and not to fear about your money. Fear and greed, two things that drive the markets. If you can use this wisely, then you can win. Nobody can stop you. Markets is a psychological thing. So you have diversified, you have allocated the portfolio, right? You are sitting for the long term. Why bother about this? Whenever there's a fall, go add some more money. Find ways to average your portfolio because you know anyways market has to come up. The global whole economy functions on the markets. Right? It cannot crash. We need to understand the reality because when fall comes, we all are in panic. That is very natural. But awareness will take you to next place. Or having a person, an advisor, can help you because they will tell you why you should not panic. Now let's see the past performance. We have taken 5 years rolling returns. If every 5 years you are drawing your money, you have invested in the index. Say you have invested in the index. So what is the return it is coming here? The negative return. How many times you have got the negative return? Hardly the unit in Nifty 50 index fund has gone by 1.5% down minus. Blue chip 0.87 minus. And Caro still the average return of the return is 3.3%. It is not negative. We have taken the average. And how many times the same funds have given more higher returns? Let's take the double digit return. If you see UTI Nifty index, then it is giving you what? About 12 to 15% return, more than 52 times. Blue chip, 26 times. And Canara Bank Consumer Trends, 19 times it has given more than 15% return. And not only that, see how many times it has given more than 20% return. Negative return, how many times it has given? Negative return. Hardly. Sometimes the average return is negative. So what is the message we want to convey here? If you're keeping a portfolio for 5 years, there is no chance that you can make a negative return. Not at all possible. More than 40% of the times, your return will be more than 18%, more than 15%. So, which has been seen here. So, risk of negative return is 0 and opportunity for more than 15% return is more than 50%. In fact, Canara Robeco is what? Sectorial fund. This is a what? This is a index fund. Then why are we fearing? Blue chip fund, in fact, it has given sometimes more than 20% return also. So this data has been taken from the past data. It is not any done data by us. It is the data of the market. You can go and check. Since 2017, we have taken the rolling returns. Right? Now, so what is actually growth of Nifty index in last 20 years? We're taking a long-term, thing. So if you had invested, say 10 lakhs in 2017 or say 20 years back, 2003, the price was 1,057 that time. In 20 years, how did it convert? It converted to 25,000. So if you say compound annual growth, it is 17%. Is annual growth year on year, your portfolio on an average has grown by 17%. Otherwise, your money has grown by 2000%. Then why will you put your money for 20 years in a product which is only giving you fixed return? That is what you pay, you get back. Why so much fear? One thing is, more than 5 years, there is no chance that your portfolio make a zero return. This is number one. Number two, in 20 years, the growth it is 17%. Then why will I keep somewhere where the growth is zero or negative? Think. You're creating wealth or you're just keeping your money to erode. Money is eroding. Money should be allowed to grow. It's only about the mindset which allows you to take the right decision. Now again, how does this money grow in 20 years? Why we talk about long term, long term, long term? See, in mutual funds, you have option to invest for 3 months, 6 months, 1 year, 3 years, 5 years. All the options are available. But why we encourage only mostly for 5 years? If you really want to create wealth, let's see. Okay, please see these numbers. Now my investment is 10%, so 10 lakhs, and I'm trying to check with different returns. So let's say we will start from say 7%. Say I'm investing in an FD somewhere where the growth is 7% compared to your mutual funds, which is 15%. Or even if you want me to take 9% in FDs and 15% in your equities. 10 lakhs investment. Okay. So the difference is what? 6% difference is there. Okay, in the returns. If you see in the first 5 years, if I had grown by 9%, then what is my profit? 5,38,000. Whereas if I grown by 15%, my growth is what? Double. 10 lakhs has become 20 lakhs. It's for 5 years. So what's the big deal? 9% hai, yahan pe 15% hai. Forget about everything, inflation or your taxation, everything you forget. Now, same thing. Let's see if you're keeping a portfolio for 10 years. What is happening when I'm keeping my portfolio for 10 years? Just a second. When I'm keeping my portfolio for 10 years, same 9% and same 15%. In 9%, how my portfolio is growing? Now the difference is what? For every 2% growth, the difference is 3 lakhs. Again, here my money has doubled. So is this growth faster than holding for 5 years? Longer I go, my money is just growing faster than before. So if you read here, every 5 years, there is an incremental growth. Here, the same 2% difference, my portfolio was growing with a difference of 3.5 lakhs. But what is the difference here now? For every percentage growth, it is 7 lakhs. What's the growth here? 12 lakhs difference. Longer you go, the compounding effect comes in. So what is happening? That where my portfolio was growing hardly by 1.3 lakhs for 2%. Now, how is my portfolio growing? 12 lakhs for every 2% growth. Now, if I keep my FD money for 20 years, and if I keep my equity in 20 years, even if the FD is giving 8% and my equity is giving me, say, 10%, even this 2% growth in 20 years is mattering what? 12 lakhs. There's a difference. I'm telling year on year for every percentage growth. So when you choose an asset class, so I showed you your purchasing power, right? Yes. So here we're talking about minus 0.55% in FDs and we're talking about 4% in equities. 4% what return it is? Now you understand. Even this 4%, when it compounds for 20 years, it is going to blow up your portfolio. Initial 5 years, you will not know. 10, 15, 20 years, the portfolio is going to be, the real wealth creation starts after your 5 years. That is why we say longer the duration, better your asset creation. Now, how do you implement it? Any doubts here? So far, any doubts, please tell me. Because it's numbers, I want to clarify. Give me a thumbs up and so I will move forward.
Ma'am, is all the figure after that 10% tax or before that?
See, here we're not taking any tax, we're not taking any inflation, nothing. We're only comparing net return based on time, 5 years and 10 years, difference. I'm again telling here, forget about your any kind of no taxes or your inflation. All we need to see here is an asset which is giving you 8% return and an asset which is giving you 10% return. So what happens in that just 2% difference, every 5 years your actually return is growing. 3.3 lakhs growth is becoming 7 lakhs, 7 lakhs growth is becoming 12 lakhs. We're telling the power of compounding and long term.
Oh.
Consider it as a post-tax return. After tax, this is the return. Clear? Any doubts? Anyone? Any doubts?
Oh.
It's clear. Okay. So this is the logic behind long term and choosing the right asset. Are 1% difference only? No. The FD and mutual funds, hardly 1% difference. How does it make it's okay? It is not that 1% is going to cost you a big amount in long term. You should evaluate and take a wise decision. You should know how the money is growing.
Yes, return.
Okay, that 1% is not just 1%. Do not underestimate the power of that 1%. Okay, so the wealth creation happens in that 1-2% only. If anyone tells you, I'll give 25% return in 1 month or 6 months, don't believe. It's all false. We've seen people burning their hands. Average return is what economic growth is. Economic growth is 17%. Above 17%, just in short term, that is 20% average is 17%. 20 years average. How can someone give you a promise to give you that return in 1-2 months? It is risky, highly risky. Your stock might double in a month. It can also go to zero in a month. It's consistent? No. Don't fall for quick fix, no money. Get rich. Nothing is like that. There is a process to how money works. Understand that and invest wisely. And doesn't matter small amount or big amount. Money is money for everyone. We need to value our hard-earned money. We're spending 8 to 10 hours a day to earn that money. It's not easy. Right? Don't go for quick fixes. In 6 months, I will become rich. I'll buy a car. It doesn't happen like that. Why are people working so hard? The richest millionaires, can't they make money like this with short tricks or trips? It doesn't work like that. Okay? Money should grow and allow you to sleep peacefully. That is how the money has to grow. So here, to just summarize this power of compounding, which I was discussing with you. So let's say when you're accumulating your money, you're investing 50,000 per month and the portfolio hardly goes to 12%. Very conservative number, 12%. 50,000 every month. So in 9 years, you are creating 1 crore. Okay? 9 years it takes to create 1 crore. But to create next 1 crore, it takes what? 4 years only. Power of compounding. And next 1 crore is created in what? 2 years only. So now your returns have become your capital and they are yielding you returns.
No.
Right? And after here, see, after the, again, after the 4 crores, less than 1 year, I'm growing by every 1 year, I'm growing, adding 1 more crore. After 10 years, now the time is coming to 10 months. In 10 months, every 10 months, I'm growing 1 crore. So only the job is to create that first 1 crore. After that, your money will work for you. You understand? When we say, let your money work for you, let the money grow while you sleep. You can just sleep now and the money is growing. Creating 1 crore is not a big deal. We need the right resources and right people to guide us. In today's earning capacity, 50,000 a month is not a big deal of savings. If you're not devoting yourself to different kinds of assets and you focus on one. And 12%, I said you, where it's a very conservative return, actual growth happens at 18% when you're crossing at 20 years. Here, so I told you 12% में ही इतना growth मिल रहा है. Then imagine at 18%. Right? That is the power of compounding. Any doubt here? Is it clear? It's a summary of what I explained you in the previous slide. Focus on the right assert. Today there was a quotation, okay, which I read and I want to mention it here. Do not worry about progressing slowly. Okay, highlight this. Do not worry about progressing slowly, but ensure you're not climbing the wrong mountain. How many of you can understand this?
Can you repeat?
Do not worry about progressing slowly. If you think the money is growing slow or I'm growing slow, whatever, do not worry about that. But ensure you're not on the wrong mountain. If you're on the right path, then don't worry about the pace of growth. You know you are going to reach there. It's not about slow or fast. However fast you grow, if you're in the wrong place, you will have to again start from zero. No point. If you're in the right direction, then even the slow progress is a progress which will compound to a bigger success. It applies to money also. Clear? Any doubts?
Take some time to understand everything.
I mean the quotation or the PPT, ma'am?
No, the entire thing to absorb, it takes some time.
See, definitely. No, it
Yeah.
is not easy. A single day you will understand everything. It's
Yeah.
only for knowledge purpose. We are there. You
Yeah.
can reach to us personally and we will explain
Sure.
you all your doubts. It's
Yeah,
definitely overwhelming to all of us that understand everything about finance.
exactly.
Yeah,
Yeah,
we
yeah.
try to make it simple, but we're given the basic information which you need to understand.
Okay.
Okay. So definitely you can reach to us personally. We are not charging anything. You can take any suggestions. There's no
Sure.
compulsion that once you come to us, you should invest with us. No. We're only doing as an awareness for women. See, I am very much inclined towards women. I feel women are best money managers, right? Men are good, but women are more good because they have this intuitive abilities also to make decisions, right? So I feel women should take the step forward at their families and their, wherever they are to
Okay.
learn investments. And one thing that stops women is fear. What if decision goes wrong? What my spouse will say? What my children will say? What if I lose this? So we want to tell you that you are in safe hands and we are there to educate you to any level you want. You don't have to invest
Okay.
big.
That's nice.
When 1,000 rupees is an investment to learn, it's only learning. Whether you're investing 1,000 or 1 lakh, okay, percentage growth is same, no?
Yeah, yeah.
Then what? You can learn anyways. There is no obligation. There is no hidden transaction cost or nothing is here. You are safe. We want women to work on that. That's why this WOMONEY is my mission on this, where we are educating women. Today, even leave the housewives. Today, even entrepreneurs, see, we are part of various entrepreneur groups. Even entrepreneurs who are doing so much of business, they are psychologists, they are coaches, they still fear money. I had to push them to 1,000 rupees, and now they're investing big amounts because fear, market investment is subject to market risk. This one statement takes your light off. So
Yeah,
we're
that's
telling
true.
you what is the market risk, how is it mitigated, and how still the money can grow. Market risk is not the way you think it is naked risk. No, you are not in a naked risk in the mutual funds. You are safe. In all other assets, you have a naked risk, open risk. But if it's fallen, the fall is big. Here it is not like that. Every fall is an opportunity. Every fall is an opportunity.
Yes.
All you need to know is focus and have the right person for you. Okay? Yes.
Yeah.
Now, so how do we utilize the benefit of this long term? Now I'm already 40. Now you're telling me long term in 20 years I will make so much money. 20 years I'll be 60. What is the point in having money at 60? This is the common mind voice. So how do we do is, no matter what we have done so far, hereafter, you can start investing for next 5 or 10 years. Currently, lifespan of the humans is 80. See, when I cross my age of 30, I want to share this here when talking about age. So we used to think 60 is almost, Maki life is almost done, retired and everything. So with this mindset, when I crossed my 30s, I had such a big phobia. Oh my God, my half life is done. And what is my life? Children, marriage, job, children, marriage, family, job, that's all. And I was like, go full on to live my dreams. But later we realized, even though we are 40 now, today's lifespan is 80 because of the medical progress of medicine. Lifespan has been able to be increased. More diseases are being cured now, right? So now, imagine you have to live for till 80. Don't think 40. Ab kya karungi? No, even 40 years down the line you have to live. And when you come to 60, 70, you will the money should serve you because now you have to rest. Just enjoy, go for a holiday, or have a relaxed life. Have people to take care of you. Have all the comforts, right? After all your commitments. So that financial freedom where you're not depending on anyone, right? So lifespan is bigger now, and so we need to, it's never late. 40, 50 is also a good time. In next 10 years also, if you create your wealth, from 60 onwards, you can just spend time on exploring your life, adventures, doing what you want to do. At 60s, people are learning dance. At 60s, people are learning to trek. At 60s, people are going to fitness goals today. In FBs, you have a lot of examples. What's stopping us? We just need to start now, right? So there is no age factor. You can start, but still, how you can contribute to people around you. Can you see my screen now? Yeah. How you can contribute to people around you is that by encouraging youngsters, your children or your might be friends, children's, whoever are the kids, if they are going to invest from the age of 25 itself, now they are earning from 18 itself. Even when they're in school or college, they're earning a side income. Earlier, they start investing at 18, 25. Even by investing monthly 15 to 10,000, they will easily touch 10 crores by age of 60. Actually, even faster than that. Here too, we have put a very conservative goal of 12%. Right? So same, if you want to reach a goal of 10 crores by 60, and currently if you're 40, then you have to invest 1 lakh per month. Okay? Definitely, our income capabilities have increased. So earlier you invest, faster the growth. Delay, the investment has to be a little more. That can be planned. Okay, so you need to plan as early as possible for your finances. You need to encourage your children to do that. Start exploring with small amounts and let them do that early. So their life is secure. Now forget the days you have to keep properties for your children. Give them, let them start creating asset now itself. By the age of their 30, 40, so secure their life completely already. Why to worry? Right? In 15 years, they will have 1 crore in their bank balance easily. And say your mutual fund is your bank balance, that is my gift for you. Forget about the properties. Right? So now, currently, youth want to live on their own terms. So we need to allow them to do this decisions from early age. Now, so before I go to the slide, I would want to pause and answer any questions any of you have so far from the slides or from your general investment experience. I'm not going to talk. I'm going to be quiet now. Everyone has had lunch and having a nap.
No, no.
I hope my voice will not allow you to have a nap. I feel so. People say me so. Okay, no doubts. Nalini, Sangeeta, Jagan, Ramya, Uma Ganesh, Hemlata, Kalpana, Saroja, Purnima, Nasia. Clear?
Ma'am, what is the, excuse me,
Yes.
ma'am, what is debt fund and hybrid fund? What's the difference?
Okay. So what is a debt fund and a hybrid fund? Now, what is a debt? Debt na kadan. I mean, you take a loan from someone. So say I want to start a company. I give you a written document. I tell you that I will pay you this much interest every year. And I take, I give you the document and take money from you to invest. It's a debt now. Now, like this, lot of instruments are there in the market where corporates borrow money from different organizations or the public to invest in their companies. But the agreement is they will pay a fixed return interest month on month or year on year, whatever dividends they pay. Now, this is called debt. It's a fixed instrument where you will only get fixed return. So risk is less because mostly in the shorter duration, they will not default. So debt we put for shorter duration. When you think that, Hema, I want money in 1 year or 2 years, it's my retirement fund, every month I want a payout. So what we will do, since debts are not very volatile, we will park the money in the debt funds. Okay. Debt funds include bonds also. Government bond, private debt papers, commercial papers or T-bills. All of this are debt. Short-term money instruments are all come in also debt. Now, equity is about growth. When you are investing, say I'm a company, one place I borrowed money from you and I'm paying you interest. Whereas unlikely here in equity, you invest in me, I'll give you a share. Okay, I'll give you a portion of share from my company. As my company grows, you will also grow. If my company grows 10%, you will also gain from that. If my company grows 20%, you will also gain from that. But in that, how much ever I grow or not, 6% or 7% is what I'm paying you, the interest. Rest is up to me. So in equity, your money is growing. In debt, your money is stable. With the interest more than FDs which you get in debt. Any doubt? Clear? Was I clear?
Yeah.
What is that ETF means?
ETFs are exchange traded funds. So,
Okay. How safe is it to park there?
yeah. So now what happens is that you have a mutual fund. If you are not wanting to buy a direct mutual fund, you can also buy through ETF. That is exchange fund. ETF will be launched time to time. They launch it. Now, unlikely to mutual fund, you cannot trade, buy, sell. No, you will not do that. In ETF, you will be able to buy and sell often. In ETF, you will have a brokerage component when you buy and sell. But in mutual fund, you don't have any brokerage component. It's only one exit, on one entry and exit.
So ETF should be done by the individual only.
No, ETFs you can buy in the exchange. Like you buy stocks, you can buy ETFs.
Okay.
Okay, ETFs are not single stocks. ETF is a combination of stocks. And like mutual fund, if you don't know anything about mutual funds, if you're not having any platform to invest in mutual funds, those people will go and buy an ETF. So like Bharat Bond ETF, a recent ETF, where all the government companies were listed. So combining those government companies, they issued a ETF of Bharat Bond. Say gold ETF. So where various gold things will be listed in the gold ETF. The gold price is equal to gold ETF.
Okay.
So ETFs
So that needs to be for a certain number of years. When you say ETF, when you buy these bonds, it has to be for a certain number of years.
No. You can sell anytime. You can buy and sell anytime. You are free. That is why exchange traded funds. So
that is taxable?
So yeah, it is taxable as per your equities only. Like you will buy and sell shares, exactly like that, it will be taxable.
Okay.
Okay. So ETFs returns are comparatively less compared to your direct funds. ETFs are tradable. You can buy and sell in the secondary market. Okay, and that is why exchange traded fund, in the exchange they are directly tradable. So they will launch ETFs here and there. That time you can go and apply at the prices. Okay.
That you need to be on the lookout.
Yes, yes. You will get a lot of ads about it also. When you are in the markets, you will get a message of the ETFs being launched. You have to see if it's really a good ETF or not. So not all ETFs will perform. It's only an idea, portfolio created and given to you. That's all. So not everything has been, performing well.
Okay.
Right. So I hope the debt and equity was also clear. Equity, I'm giving you a share of my performance. Debt, I'm only giving you a obligation of this return. That's all. I don't have any other obligation from you.
Okay.
Okay.
Yeah.
So risk is when I default, I might it might affect you also because you are a shareholder in equity. But in debt, I have to first pay interest.
Yeah.
Right. So that is what debt and equity. So debts are like instruments for low risk, where short term, less than 3 years, if you are parking a money, we will be using debt. If you say that in 3 years, anytime emergency will come, so part money will park in debt and part in debt. So hybrid is equal combination of debt and equity. Depending on the market, what they will do is when market is low, they will buy equities. Move the money from debt and buy in equities. When market is in peak, we'll buy debt funds. So that when market falls, I will buy into equity. So this happens inside the funds also. And as advisors, we also do that for the clients. Most of the clients would be aware that we buy debt. Sometimes we buy equity. Sometimes we don't always put all the money into equities. Blue chip fund. So every fund has a name based on the components of the fund. So when I say small cap fund, it has all the small cap companies, most of the small cap companies. When I say mid cap fund, you will have most of the mid cap companies in a ratio. When I say large cap or blue chip fund, most of the large cap companies or Nifty 50 companies will be in that in different ratios. Clear? So blue chip fund, only blue chip stocks will be available there.
Okay.
Okay. So we'll do one more session explaining types of funds also sometime later.
Yeah, sure.
Okay. If everyone is interested, we will do a session on that also.
Can you please give example for short, small cap, mid cap, and blue chip? Just few examples.
You want some example of a small cap and large cap fund, right, ma'am?
Medium and large cap.
Okay, fine. So 1 minute. I will just open a fund and show you. Okay.
Hi, how can we find which fund is doing good?
Madam, that you have to study which fund is doing good. There are various factors. That is why we are there to help you on that.
Okay.
Right? That needs that you will need education on how to evaluate funds, how to see the funds. You see, normally seeing the last 10 years performance is different. But which fund is good or not, we need to really go deep and see the strategies which they are using.
Because some funds are giving 11% and some funds are giving more than 20%.
That is why you need an advisor to tell you.
Okay.
That you do.
Actually, our advisor is not able to give that suggestion, I think, because I have invested in various funds and upon doing we find some funds are giving 11 to 15% and some funds are giving exorbitant 25% also, because we are not able to judge and we are not able to follow that regularly. How can we keep his eye on them?
Yes. So, ma'am, the thing is, as I said you, there are more than 1 lakh funds, right? So what happens? Your advisor designs your portfolio based on the returns and the goal. Now, see, I don't want to comment.
Having so many customers.
Sorry, ma'am?
Because because he may be having so many customers. I'm right.
So now how many of our customers you have, there will be some funds which I'm regularly watching, which has seen the
Okay.
performance, right? So I cannot, if I have 100 clients, I cannot change strategy for all the 100 clients. Only
Okay.
minor changes will be there client to client, but the base foundation will be almost same. Okay, if I'm
Okay.
finding banking sector is doing good, so most of all my clients will have a banking fund with them. Quantity will
Okay.
differ, combination will differ, that is different. If I'm seeing that the consumer is doing good, all of my clients, I will give a consumer SIP and consumer lump sum fund. So I will have a common view of the market and what is growing. So I have to give the benefit to all the clients. Now, challenge here can be, one client has given me 10 lakhs. So I have flexibility to invest in different buckets. But one client has given me 1 lakh. I will have less flexibility or bandwidth to expand their portfolio. Right? That only can be the challenge. Otherwise, all the clients, I will have to give the similar benefit only. Small tweaking will be there on quantity, on the risk. So if the client is having 10 lakhs, I will give more risky funds also to them, because I know they can manage and I can balance it with other portfolio. But the client is giving only 1 lakh, I have to limit the exposure for them. Right?
Okay.
But my recommendations will almost 80% will be the same. 20% tweaking only will happen. So it doesn't matter if I have 1,000 clients or 5,000 clients. Right? I have to give them the knowledge and the education on what is doing good and what changes we are making. Every client will be communicated on the changes we are doing. Now, if the client is interested, they will take up, or not, they will not take up. Right? So I don't want to comment on any other advisors. You see, it depends on case wise and client wise. So we don't want to comment on that. But your advisor will be able to pick up that kind of funds. And when you see in long term, see, don't evaluate returns on in this 1 year, this fund gave good, this fund didn't give good. No, don't go by that. See the 5 years performance and see whether the combination that your advisor has given has gone well or not. In long term, the return should be minimum 15% and above. Long term means 5 years plus. If that does not happen, then the justice is not done. Clear? In first year itself, we cannot decide. First year, we know 6 months also our portfolio has given 40% sometimes. But we don't market that. We don't tell to our clients, you see this portfolio has given 40% 6 months. You come invest with us. Never. It is not professional to do that. I have to show them a return. See, this client is for more than 5 years with us. See his gradual progress. See his return that he has given. That is the right way of educating a client. So short term, it's only manipulation. Long term is the reality. Don't go for short term. And might be we will come to a one-to-one call where we can discuss where you think is a mismatch of the returns which you're talking about. So I can give you better clarity, because we cannot generalize it. Right?
Okay.
It differs from portfolio to portfolio. We can evaluate your portfolio. We can do free evaluation of your portfolio. That's not a thing. So let's take an example. Yes, ma'am. Someone is asking something.
Yeah, myself only. Actually, we have to, do you mean to say we have to hold the funds minimum 3 to 5 years? I'm right?
Not same fund. See, in the 3 to 5 years, sometimes the funds might change also. See, this is your example. Say IT has done extremely well. It has given me 40% return. So will I hold IT anymore? No, I will switch from IT to other banking. Then to small cap. Now small cap has already performed in last 6 months. I'll quit and I'll go to large cap. So these changes will keep happening, but you remain invested. That's all. Say if you have invested 5 lakhs or 1 lakh, you will remain invested. Changes will keep happening. Your advisor will tell you the changes to be done.
Okay.
Okay. So it's not the
Actually,
same
we
fund
have
that
to
sits for
set
5
a goal.
years.
Okay. Actually, we have to set a goal that we should get this much return, and after that we can quit that fund, or we can keep on investing in that same fund.
Yeah. It should never be goal for return on a certain fund, because that might also fail. You will be disappointed. It should be my wealth goal. I'm giving you 10 lakhs. This is the return I want, or this is my goal in 3 or 5 years. Or I'm giving you 2 lakhs. In 3 to 5 years, this is my goal. Or in 5 years, I want to reach this goal. What is the monthly amount I should invest? This is how we should design a portfolio. Not on
Okay.
key, can I buy this fund? If it comes 40%, I'll exit. No, that you're not trading. You are investing. You are creating wealth. We are not trying to grow in a short-term money. Wealth can be created only when you have discipline. Otherwise, wealth will not happen. Short-term money will come and leave you also same way. Okay. Example, you invest 1 lakh for 6 months. The fund grows for 40% 6 months. Say it crashes for 20% in next 1 month. What will you do? How do you know when to exit? That's all trading. That's all no speculation you're not supposed to do. That happens in stocks. People do that. That is why we say stocks are risky. Don't go for that. That is why mutual funds. Here also, if you're going to do the same mistake, then no point.
Okay.
Right? We need to very deliberately work on that. So this education your advisor gives.
Ma'am, keeping a fund manager, we have to pay something for them, or
For
Ma'am,
the
you will,
managing?
you will not interact with the fund manager. Nobody, none of you will interact with the fund manager. Fund managers
Okay.
are there in sitting in the AMCs. You will interact with us. We will tell you which
Okay.
fund to choose. We will evaluate the fund manager is good or bad. We will evaluate the history of the AMC or the fund manager. That is our work. That is why we are here. Because we are in the industry. We know which fund manager has been doing what returns he or she gave, and all those stuff. I think net is disconnected. Please wait.
Yeah.
Am I audible now?
Yeah, it's clear.
Right? So we are here to do all that homework. Which fund manager, which portfolio, how long, past performance, good or bad, what technique they are, what technology or what strategy they are using, all these things. So you will talk to us. We will guide you according to your goals. And you don't pay any fees to us. I told you that we will give you a free portfolio evaluation. We told you we will evaluate your existing investments on whatever, whether real estate or debts, whatever debts you have, whatever loans you have, whatever insurance we have. We consolidate. We will tell you this can be done with this, and this can be held, and this is how you can additionally do this to achieve your goal. Because we see a lot of clients have a scattered insurance. So many policies they have taken the name of investment. So many, they have scattered investments here and there. They're invested different in the form of direct fund. They're invested in AMCs. They're finding it difficult to redeem now. So we do the service by consolidating everything and helping you to create a proper goal. Then you don't pay any service charge to us. It's only value addition to you. Okay. There's no hidden charges here.
Okay.
Did I answer, ma'am? Any other doubts?
Oh, yes.
Okay, fine, no problem. So I think someone had requested to show a glimpse of a portfolio. Okay. So I just opened a random portfolio. Okay. So now if you see this is a Kotak small cap fund. Okay.
Okay.
Say 1 year returns. What is the return given here? 24%. Everyone observe here carefully. 24% annualized returns. Okay. And just a second. So what if I change it to 3 years? 1 year it was 24%. Now I'm changing it to 3 years. Now you see the returns.
Can you move the graph?
Yeah, I just. Now see what is the returns. Kotak small cap has given 22%. The box it is showing 22%.
Okay.
So your average returns I'll show down. Just a second. 1 lakh upfront. Oh, just a second, please. Let me. Okay. So in 3 years, it is 25%. Can you see this, the top?
Okay.
Now I changed to 5 years. I'm changing the returns to 5 years. 28%. If
Great. Yeah.
see, if I was holding for 1 year and exited, it would have given 43%. Okay. Now, 3 years average. It is average. Okay. 25% is your portfolio return. You saw in what did you saw in 5 years? 28%. When it goes to 10 years, 23%.
Okay.
When to 7 years, it was 19%. As we talk about average return, because not every year will perform the same way.
Yeah.
And there's a possibility that the first year could have been negative also. So let me see some. Let's see 6 months. 3 months. So not always return is same. It is fluctuating depending on the period. Is what we're trying to tell you. Okay, you want to see the portfolio. Let's see a sample portfolio. Why mutual funds? Again, okay. Just a second. I will just open a portfolio and show. Is my screen visible? Just let me know if my screen is visible. Right? So portfolio summary, what are they telling you? That number of stocks is 79. See here? Total stocks in the portfolio is 79. Now tell me, if you individually had to create this kind of return, that is what, 40% return or 29% return, do you think you can choose 79 correct stocks in the right ratio? One minute. Yeah. Right? It's not possible for us. Okay. Top 5 stocks weightage is 16% and top 10 stocks weightage is 25%. Now, what I wanted to observe here is, see, let's say the top few companies. Okay. We don't need the whole 79 stocks here. Now, see, say they had taken CN Tech Limited. Hardly 4% is the exposure to this company. Did you see?
Yeah.
So even if this company goes bankrupt, what is hardly my portfolio losing 4% of my investment? Is it going to affect you? See, fund managers will not wait till then. They will exit in 10-20% downside, so they'll exit the company. But I'm telling you the worst case scenario. But if you had personally done this, tell me, can you do the right allocation like this? That is why you need a portfolio. Clear? Any doubts in this?
Okay.
You have to do so much of research to go and search for small cap companies. It's not easy because they will suddenly go zero. That is why there has to be a proper allocation. This is what we see allocation. See, hardly 2% of the money. If you give 100 rupees, 2 rupees only in the stocks they have invested.
Oh, yeah.
So what is your loss? This is called allocation. For that, you need an expert. You cannot do it on your own. This is how a portfolio looks. So these kind of research we will do. We will go study what stocks are there inside, which company is good, not good, why they have taken this stock, what is the ideology. This is our work to do. And that is why then we tell you, ma'am, this fund we can buy. So if we have chosen some funds and we keep changing that funds based on the strategies that the fund managers are implementing. Clear? No, you don't pay us anything. I clarified as in the, earlier. You are not paying anything for our services. You show your portfolios. We give you suggestions. If you like it, then you open your account on the platform PG Asserts, and there you will be able to invest. To directly invest the money. Money goes from your bank to BSC Star MF. The money goes from there. The units get allocated. We are not handling your cash. We are not charging anything from you.
Okay.
AMCs are paying us. See, there are fee-based advisors. That is different. We are not fee-based advisors. We don't charge anything for a portfolio maintenance. Okay. So this I want to clarify. Any doubts in this, anyone?
No, fine.
Yes, ma'am. Yes, you were just telling something, Kalpana, ma'am.
Mm.
Are we good?
Fine.
Now it's audible. I'm sorry there was disconnect. Please tell me. Kalpana, ma'am, you're talking something.
Yeah, it's audible. I'm able to follow you.
Yeah, someone was asking some doubt. In that time only the internet got connected.
No, nothing.
Okay, fine.
Oh,
Now
thank
I will show you a summary. So final slide. So comparison of various asset classes. I was telling you that gold, whenever you get a wealth, you should see at least 10 years of the growth. Because in 1-2 years, it's not wealth creation. Now, just notice, let's take gold. Okay, because that's easy to compare also. We'll take Nifty, small cap, and we will also take gold. Small cap is said to be very outperforming and risky also. Now, FI14, 22% return. FI15, what was return? 62% return. FI16, small cap was negative, -6%. Again, small cap, 40% growth in FI17. 12% in FI18. Again, small cap, 12% negative in FI19. COVID time, markets were down. Again, 40% down. FI20. Then it moved by 118%. Then 37%. And then -6% in FY23 last year. So, what is the average return? You saw market grew up by 118% small cap return. -40%, you would have been scared. But if you're invested for 10 years, compounded growth was 15%. So if you had, when market fell down to 40% minus, had you invested, returns would have been awesome. But we're not talking about all those things. But when you are with us, we will remind you, ma'am, market is down, please go invest. You can break your FDs and invest. Any money you have, please go invest. That strength and confidence, who will give you? Your advisor, because he or she knows. But you will fear. You will be fearing that time. But we will educate you. Now, compared to, let's see gold. Gold was -8% FI14, -6% FI15. Then slightly it moved up to 10% FI16. Again, gold -2.3%. Again, 5% up FI18, 1% up. Now, See the contrast. Gold 37% up and Nifty small cap down by what? 40%. I told you, when markets are failing, gold will come in place. When markets are good, gold will be very nominal. See, very nominal, very nominal. Minus or plus will be both very nominal when markets are good. Again, when markets were reviving, then what was the gold? Minus 2%. Again, 16%. Again, 13%. When markets are normalizing, gold returns are also hardly minimal. So what is the average of gold? Least return out of all the asset classes is 6%. Least of all the assets. See, I did Nifty large cap, S&P, T-bills, G-Sec bond, debt also. So lower than debt funds also, the gold has given return. But what people are thinking now, recent 4 years, gold extremely went well. Should we invest in gold? No. Gold is not an investment. Gold is only a hedge. Gold will only work when markets are not performing. Gold is not a wealth creating asset. It's only for safety. Got it? Clear? There is no hatred against gold. I'm telling you, don't buy gold to invest. Buy gold might be because you like it. Or buy SGB. If you still want to buy gold and you think it's an investment, buy sovereign gold bonds. They're paying a 2.5% interest also, no? Physical gold, this year you like a design, next year you don't like a design. You're buying gold for your daughter-in-law or daughter, she will not like the design at all when she wants to marry. Buy SGB, redeem it, buy the gold you want that time. Clear? Asset comparison in 10 years. So we should see 10 years, not in single year. You will make wrong
long
decisions.
term.
Yes. In the short term, you will make wrong decisions only. Don't fall for short-term returns. Again, why we keep telling, please don't fall for quick fix money making schemes, please.
Okay.
Yes. So this was about your investments. Any doubts, I'm open. And anyone who, no, you are welcome to text me in the group, okay, for a portfolio evaluation, free portfolio evaluation. You can just type money, okay, and we will reach on to you for your portfolio evaluation. We'll guide you, and then it depends on you. If you're comfortable enough, you can go ahead. Okay, any challenges, we will help you to educate.
Okay.
This is from my end. Now you all are open to talk.
Anyway.
So because it's for women, no, we thought we will keep on a weekend, so weekday, so that all of your family members are out for work and you can have time. Because weekends, women are busy serving their families. Right? So that's why I hope you people were able to observe and it was interesting. I hope I didn't bore you. I know the information was a lot, but please bring in your personal queries one-to-one, we will clarify. It is not possible to single day grasp everything.
You need some time to sit and
Definitely. Okay.
Yeah,
I will
sure.
post the link, the recording. You can also go through that also later. Or you can share to people, whoever you want.
Okay. I think that
Right,
that's
ma'am?
good actually.
Yes. So any other doubts?
And the
Any
number to be reached also to you.
Yeah, I will put the number in chat box. Kindly text us 9962204768. Okay. You can text us or 9952964768. Okay, you can personally message me. My name is Hema Raju. Okay, so you can text us to our numbers and we will guide you. You can type comment WOMONEY. Okay, if you are from the webinar and you want to reach on to me, we will personally reach on to you.
Just a moment.
Okay, Hindi, English, Tamil, Telugu, any languages are welcome. We can address you in any of these 4 languages. No language barriers. I hope this languages cover major part. Okay,
Yeah, exactly.
so you are free to reach out to me for any language. Okay, ma'am. So I hope we all enjoyed. Thank you everyone for being such a patient audience. And thank you, Hema Malini ma'am, for helping us to organize this, and for being participative, everyone. Please, thank you, Hemalata ma'am. And everyone, please try to improve your knowledge. Okay, it should never be that you keep yourself away from something. Again, I'm telling, don't invest 10,000, 50,000, 1 lakh per month. Invest just 1,000 rupees a month, because today even one set of salwar you have to pay 1,500 material alone. If you go out, 1,000 rupees is nothing. So 1,000 rupees per month, can't you invest it for your own knowledge? You can definitely, you'll not lose anything here. So please go take effort and educate yourself. So tomorrow, at least you can educate your children, if not your spouse, or you can also help your spouse also. Or 10 women like you can spread the awareness. So women don't feel aloof to talk these topics. Right? You don't have to be working. You don't have an entrepreneur. Even housewives, they do a brilliant job. If we remember our ancestors, I think our grandparents and all, even though their spouse used to beat, they never were allowed to go out. They were so smart to still save some money. For emergency, they can go and take in the Vechiko, keep this money. How? We don't know. They were smart enough. So please come out of your cocoons. Don't fear anyone. You need to figure out how to make your own path. And investment is one thing that will give you financial freedom, confidence, and everything. And we are always here to support that. Okay. So I'm also transformational coach also. So I think from there, this energy comes where I want all the women to please break your inhibitions and come open up. Any help, we are there to help. Okay. Thank you for staying so long. Yes, I hope.
Thanks so much.
Thank you, ma'am. Thank you. I hope I'm sticking to my time.
Sure.
Bye-bye.
We'll be in touch with you.
Thank you.
Yeah,
Thank you
sure.
so much.
Thank
Bye-bye.
you. Thank you, everyone. Love you all.
So much.